What's up, guys? Welcome back to DCA. Today, what we're going to do is talk about building a blueprint for investing in the cryptocurrency asset class that you can utilize going forward into 2022, regardless of whether you're someone who just came into the bull run at some point in 2021, or whether you're someone who's been investing in crypto for years now. So essentially, these are just best practices and just things that I will personally be doing going into the market in 2022. Right now, we're sitting at a transition point. Bitcoin has fallen below its 20-week moving average, which is typically a bearish sign. However, when we look at the on-chain metrics, as we've been doing these last few weeks, we see that there's lots of bullish signs in the market. So we don't know what will happen in 2022. But what we do know is, regardless of what happens, there are certain best practices that you can take as a retail investor in order to position yourself best, regardless of whether we go into a bull or a bear market. If we go into a bear market, then we'll be in a position where we're acquiring with the idea that we're going to be holding long term. And typically, these are actually the best times to be investing in the cryptocurrency asset class. If we continue into a bull run, well, we can position ourselves optimally for that as well. Okay, so we're going to look at techniques and things that you can do in order to position yourself optimally, regardless of which way the market goes. Okay, so before we jump in though, let's quickly talk about a few things. First of all, I say in number one that the rags to riches phase of this market cycle is likely over. Now, what that means is the phase of the market cycle where a lot of these coins have gone up 10x, 100x, 1000x through the stages of the early part of the market cycle. That part of the market cycle is likely over, okay? It will still happen for some altcoins, but the market caps of a lot of these coins have gotten so high now that it's simply not mathematically possible for them to do that. All right. There's only so much money that can come into the asset class. And for, a lot of these coins to again do a 100x or a 1000x, for instance, let's take the case of Solana. If it's sitting right now, I haven't looked today, but between a 50 to 60 billion dollar market cap, for it to go up 100x from here is going to give it a 5 to 6 trillion dollar market cap. And that's simply not very likely during this market cycle. It could happen in the future in another market cycle, but it's not very likely to happen this market cycle. If Solana were to 100x from here, that would give it a higher market cap than the entire cryptocurrency asset class. It's not going to happen, okay? So when I say rags to riches, I mean a lot of the, putting $100 in, $1,000 into something and it becoming worth $1 million. That stage of the cycle came and went. Probably, at some point you needed to be into the market at some point in 2019 or 2020. So if you missed out on that phase, it doesn't mean you can't still make great profits during this market cycle. It simply means you need to temper your expectations. Align your expectations with reality. Okay, which brings me to point number two. If you're someone who watches a lot of, crypto YouTube or reads about crypto on Reddit, you'll know that there is so much junk out there being shilled on YouTube and Reddit, any form of social media essentially. So this is actually why I've recently entered the crypto YouTube space, because I just saw so many people just buying into, people will be shilling any number of junk coins. Some of them may believe what they're saying. Others may be lying to you maliciously for their own gain. Who knows? And that doesn't matter. If you're someone who's out there chasing these types of coins left and right, just ask yourself, have you ever become rich by doing this? You can go out and buy a lottery ticket also. And your odds of winning or hitting and selling at the right time are probably about the same as winning your state lottery. Okay. So I'm just saying this. I don't like to badmouth other channels. I'm just saying this because I see so many people, including people that I personally know, chasing these type of junk coins. And you hear, you hear about people becoming millionaires from doing this. You also hear about people winning the lottery. And, it doesn't mean that you're going to do it. All right. So I've said this before, but just be careful. If you want to put a very small amount of your portfolio into things like this, that's fine. People can, like I said, play the lottery also. So if you want to put a small amount, and we're talking less than 1% of your portfolio into these types of coins, go for it. But if you're doing more than that, I really think you're hurting yourself in the long run, okay? Because that small amount that you put into these that is probably going to go way down or close to zero, that small amount you could have had in better projects that will multiply over time, likely. And that small amount, if you look at just the rules of compounding interest, you're losing out on a lot of money in the long run. So you really have to think about every dollar that you invest and think about it critically. All right. Because what doesn't seem like a lot now, especially if you're a young person, what doesn't seem like a lot now truly can become a lot if you use it wisely in investing. Okay. So the last point I want to make is short-term price predictions. Your day traders, your people that are, telling you, I don't like to, I don't, like I said, I don't like to badmouth people. And at the end of the day, I'm a channel with 1,700 people. And the person I'm about to mention is a channel with probably millions of followers. But like, when you hear this short-term prediction for November that Plan B was making. Now, with that said, his model thus far anyway has overall been accurate. But like the November prediction, I sort of thought that was irresponsible of him because, you know, at the end of the day, people that, have significantly less money than he has are, believing in him and sort of betting their hard-earned money on the predictions that people like him make. And it's completely irresponsible because, he has no idea where the market is going in November at the end of the day. First of all, his model is taking an average of, a certain, his prediction anyway, is an average price over time. So for him to be predicting, whatever he said, I don't know. I don't even know what it was, 90,000 or something in November. I feel like that was, highly irresponsible. And at the end of the day, though, you're responsible for your own investments. So if you're buying into things like that, you know, you need to step back and ask yourself what you're doing. Because if you think that one individual out there knows what the price is going to in a particular month, you're fooling yourself. Okay? You're fooling yourself, and all you're doing is lining their pockets. All right? Because his business has grown exponentially based on these short-term price predictions that he makes. While a lot of people, buying into what he's saying, using leverage, well, guess what? $5.4 billion of liquidated longs occurred just a few days ago. So ask yourself, should you be investing based on the short-term predictions of others? So the same thing in general goes for day trading in crypto. It's not like a forex market or, the general stock market. If Bitcoin takes a swing either up or down, the whole market is going to get dragged along with it. Okay? Just take a look at December 4th, what happened. And, if you're unsure, look at the day before your momentum traders and your day traders. What were they recommending that you do? Did it involve Bitcoin dropping 10K in a single day and, dropping a lot of the altcoins by 25% in just a few hours? I highly doubt it. So you need to just step back and look at the advice you're taking. There's a lot of good YouTube channels out there. A lot of data driven YouTube channels. Well, not a lot, but they're out there. And I recommend that you just take a step back, and ask yourself who you're getting your advice from and is it actually helping you? Has this person ever actually benefited you in any way? Okay, so that's that. With that said, let's get into the video. Okay, guys, so after the longest intro in crypto YouTube history, let's take a look at the blueprint for investing during 2022. All right, so I'll try and get through this stuff quick. So the first thing, acquire assets using a dynamic dollar cost average approach. Okay, what does that mean? So what this means is, if you're familiar with the channel at all, we use the DCA Index risk model here. Now, what this model does is identifies where market cycle peaks and bottoms occur. Okay, so you can see that basically this is the DCA Index model. And what it is a machine learning algorithm model which identifies when a market cycle peak occurs and typically when we are nearing or at a market cycle bottom. All right. So it's optimized in order to identify these peaks and bottoms. It takes into account numerous different factors, but it's basically looking at extension from various market levels. So what that means is as the market gets more overheated, okay, so as it gets overheated, it becomes statistically improbable that the price will keep moving up. All right. So this model captures that and identifies when historically that is likely occurring. And when that happens, in the past, it has typically led to either a complete market correction. So, in other words, like we saw in the first leg of 2013, and like we saw in May, we had just a massive market correction, okay? Or the beginning of a bear market. So, like we saw here, like we saw here, and technically you could say this was a mini bear market that we saw here. Although I would more so label it as a correction. All right. So when we say that we are going to dynamically dollar cost approach this market, what that means is as this model moves below 50, so you can see it's scaled from 100 down to 0. When it's below 50, typically these are the best times to be buying Bitcoin. Okay, so we're looking at the Bitcoin model here specifically. So this model also exists for Ethereum, Solana, Cardano, Polygon, Link, numerous other top altcoins, Polkadot, things like that. So we have it for a lot of the altcoins as well. But this is the Bitcoin index model that we're looking at. So as this value moves down, so from 50 to 40, 40 to 30, etc., down to 10 to 0, we will increase the amount of Bitcoin that we acquire as it moves down. Now, the reason that you acquire more as it goes down is because if you let's say you were using this in the prior market cycle after it peaked in the end of 2017. So you could have been buying here, certainly. All right. And according to the DCA index, you would have been founded in doing so, and you would be acquiring at around 10,000. Okay. But then when it started to move down into the 30s, for instance, Bitcoin was priced at around 9,400, then 9,500. Then when it started to get into the 20s, well, now Bitcoin's down to $6,000. So you're buying more. You're buying 2x at this level. So now you're buying twice as much as you were buying at 10 to 11,000, right? And then finally, it dropped into the lowest tier, which is right here, and you would have been buying 3 times as much Bitcoin at around, let's see, so you would have been buying it between 4,000 all the way down to $3,000. You would have been buying 3 times as much then. So historically, when the model gets down to this level, and you can see the same thing back in 2013, or well, this would be 2015. It was down at this lowest level just for a short time. All right. And we saw Bitcoin go all the way down to $150 at that time from the price peak earlier of around 11 or $1,200, right? So conversely then, when the price of of the various coins or tokens moves in above 50, up 50 to 60, 60 to 70, etc., up to 90 to 100, you will increase the amount that you sell during this time. So in other words, dynamically selling your Bitcoin as it moves into the higher tiers. So if you notice, Bitcoin reached its peak actually in February on this scale. It got into the highest risk band in February, on February 21st. It was at a high that day of around 58,000. So you would have sold your remaining portion of your Bitcoin according to the DCA Index schedule. So if you see here, you would sell 10% at this level, 15% at that level, 20%, 25, 30. And these are just general numbers. You could use whatever numbers you'd like here. And there's different ways to go about doing this. But the idea is, as it's moving up, it's becoming significantly more overheated and likely going to pull back. And sure enough, when Bitcoin got to this highest level, it only went up a few more percent from there and then crashed down. Now, more importantly, if you sold your Bitcoin here and moved it into altcoins, you could have captured multiple X gains that the altcoins typically went on after February. Okay. And likewise, you would have been primarily out of your position in the first place because at around 40,000, Bitcoin did get into the 80s. Okay. So you would have sold 10, 25, 45, and 65%, or sorry, 70% of your position, back in January. So you may be saying, well, Bitcoin still went up, almost another 50% from January. So how is this model any good? Well, recall that if we go to the altcoins, for instance, and Ethereum didn't go up as much as a lot of the other altcoins did, but if we just go look at Ethereum, Ethereum went up. So you would have sold your Bitcoin position and moved some into Ethereum, let's say, and Ethereum went up 226% from that point. And if we say look at Solana, well, what did Solana do? So from the time where you would have sold your Bitcoin, Solana then went up 6,000%. So you would have been sacrificing the 50% you could have made in Bitcoin for 2x or, many more x in some of the altcoins. All right. So it just goes to show that, a model like this is kind of pointing out to you where to be selling your Bitcoin and where to be moving into other positions. All right. So a dynamic dollar cost averaging approach to the market. So I'm actually going to be making a complete strategy video for the DCA Index risk model tomorrow. And this model is actually, the model and the trading view indicator are available to sign up for on my Telegram channel. So if you head over there, you can sign up for it and I'll send it out to you. All right. So that's the first thing. And by the way, personally, I dollar cost average every Friday. There's some evidence, it's pretty weak, but there's some evidence to say that Fridays are the best day to be dollar cost averaging. Okay, so that's the day that I DCA. Okay, guys, so that brings us to number 2. And this is that going forward into 2022, I will be acquiring Bitcoin, Ethereum, and altcoins in a ratio of 45 to 35 to 20. Okay. The reason that I'm doing this is because typically Bitcoin will lead off the market cycle. All right. Bitcoin and increasingly so Ethereum. So what that means is if Bitcoin starts really moving against the US dollar, so rising against the dollar, typically the altcoins will stay behind. They will not move up quite as much. And in fact, a lot of times they will move down. That's because all the money in the market is being pulled into Bitcoin. So this is just a look at the market and the top altcoins at the time during the 2017 market cycle, you can see that we're basically looking from the time that Bitcoin fell below its 20-week moving average. So over time, everything was bleeding down, and we're going from 2018 into 2019, and then eventually into the start of this mini bull run that we saw. Notice that as the markets continued, the bear market continued, Bitcoin was falling down. In fact, hemorrhaging, you might say. But look at everything else. Look at how much everything else lost. So Bitcoin was down at its worst at around 55% or so from the time where it fell below the 20-week. But look at the other coins. They were getting absolutely hammered. So, a lot of these coins were down 90%, 89%. So if we just, look up here, 81%, 86%. XRP was probably doing the best at the time, 60%. And what has XRP done this market cycle? Absolutely nothing. In fact, a lot of the top altcoins that people were investing in back in 2017 have not done much at all this market cycle. So this is the whole idea that between market cycles, you don't know what's going to happen to the altcoin market. You don't know if the coins that we all love right now, if anyone is going to care about those in the next market cycle. So if we're in a bear market, you don't want to be investing heavily into these because you don't know if they're ever going to recover. They may fall out of favor. The projects may simply not live up to the hype. Remember, this is a highly, highly speculative market that we're investing in. The only two constants that we've seen so far are essentially Bitcoin and Ethereum. There are some others, I'll give you that. But at the end of the day, the only constant growth, more or less, that we've seen is Bitcoin and Ethereum. A lot of these other coins have simply not lived up to the hype or got absolutely hammered during the bear market. So let's go to number 3. And this is actively acquiring staking rewards immediately upon acquiring a new position. So for instance, let's look at things like Solana and Cardano. If you have positions in Solana and Cardano and you're not staking them, you're losing out on a significant profit that you would otherwise be making. So, let's say you just bought Solana and it's down, I don't know, let's say over the course of a year of you holding it, it's down 15%. Well, you could essentially wipe out that loss just with your staking rewards, okay? And then have the potential of that being exponentially more valuable to you if a year from now it then goes up 4x, okay? So a lot of people will get into these positions and then just leave them sitting on an exchange and not even be acquiring profits from them. Now, I know a lot of people will be rolling their eyes at this because I think it's, general, well-known practice to stake your rewards or to stake your coin or token that you're invested in. But there's also a lot of places where you can be staking and earning rewards in different DeFi protocols that you might not even know about. A lot of people don't know what the options in DeFi are. So that's actually something I'll be covering in some future videos coming up, is ways to be earning rewards on things like Bitcoin even. So one of the protocols that I'm most heavily invested in DeFi, for instance, I'm getting about 60 to 70% on my Bitcoin right now. Okay, so most people just have their Bitcoin sitting on the sideline and are earning nothing for it. All right, so things like this can make an absolutely massive difference at the end of the year when, when all the dust is cleared. If you're getting 50, 60, 70% on a coin that otherwise you would have just had sitting there, that can make an absolutely huge difference. So the one other thing I wanted to mention about that is to be careful if there's a long unlocking period. Now, there just might simply be nothing you can do about it. And if that's the case, then so be it. But sometimes they will have something like a 2 week unlocking period or, several days. And if the price goes parabolic and you want to be able to sell the coin, you may not be able to if you have to unlock it. Okay, so this is just something else to think about. All right, number four is something we've already talked about. Historically, Bitcoin is going to move before the altcoins, and we can just look at that quickly, actually. Okay, so this is looking at Bitcoin compared to just to do it quickly, Cardano and Ethereum. And you have to remember, Cardano, while not doing well recently, I know that people have the memory of a goldfish when it comes to cryptocurrency. But remember, earlier in the cycle, Cardano was absolutely crushing essentially everything else. So here we're looking at Bitcoin versus Ethereum and Cardano. Now, if we look at this from the perspective of a long-term investor, which is what we do on this channel, if you want to day trade, there's guys out there, wearing sunglasses in the dark that will tell you that they're the best day trader and about the 5 million X altcoin that you need to know about today or you're going to miss out. That guy's out there. I assure you, you can find him. But if you're taking the perspective of a long-term investor, so we see here that Bitcoin fell down less during the bear market than everything else and then went up significantly higher up until this point. So if you're looking at it through the lens of, buying Bitcoin from this time, holding, and then getting out, right in February when the DCA Index Model indicated that Bitcoin was high risk, Bitcoin was crushing everything else then. All right. But then, and this happens quickly, just, a few months later, basically everything else is crushing Bitcoin. Okay. So as a long-term holder, typically you will benefit most by buying into Bitcoin and probably Ethereum going forward in the setting of a bear market and then shifting that position into the altcoins once it goes parabolic because it will typically lead off the market cycle. Number 5 is an important one. Don't sell a position which isn't performing well at the moment because you want to chase a short-term pump of some other coin that you're watching. I've done videos about this before, but you see time and time again, this is a classic thing that I see people that I personally know in this asset class doing. They will hold a position, it will be down 20, 30, 40%. Something else will start pumping. They either panic sell or just get impatient, and impatient in cryptocurrency means weeks or a month. And they leave their position, they chase the thing that's pumping, the thing that's pumping sells off, then the thing that they were just in starts to move. You see it time and time and time again in crypto that, if something hasn't moved in a couple months, people get impatient, they leave it. And then the second that they're out of it, then it starts to go. Okay, so this is something that I constantly see people getting wrecked by. And this is something that you should avoid. It's just an amateur move. Okay, it's why crypto up until now has been just a cakewalk for whales, because they're playing the game against basically no opponent. In the stock market, if you're a multi-billion-dollar investor, well, guess what? You're playing against hedge funds, things like that, with mega time money. In crypto, these guys are playing the game against retail investors who are chasing pumps, and they're doing it methodically and repeatedly and predictably. Okay? If you're this guy, if you're doing this, you might as well just take your money out and stop investing in crypto, because you're never going to make money doing this. You're chasing something that has just gone up multiple X and thinking that it's going to continue going. the people that are making money in crypto are people that are sitting back, buying good projects when they're oversold and holding them. Okay. And then selling them when they become significantly overextended. The people that are making money in crypto are the people that are buying and selling to this person. Okay. And I have a feeling that a lot of people are this person. I was this person at one point. I think everyone, every retail investor almost, save for the most diligent, were this person at one point. Okay. It's very difficult not to do it because you get these massive downside swings. You're not used to it coming from different asset classes or the equities market. You're not used to the downside volatility. When it goes down, you're not ready for it. So you panic, you chase the thing that's pumping sells off, etc. Rinse and repeat. Okay. So if you want to make money in crypto, you need to develop a long-term outlook on the market. All right. So the sixth thing, and we've already touched on this, money which is on the sideline is wasted money. It's getting crushed by inflation daily. You want to have, so something that I should have mentioned earlier, but when I say dollar cost average, pretty much, I can understand if you're in a position where you don't have a lot of money to invest. And so you just want to get it all in, and you kind of have to assess that position for yourself. I can certainly, understand that position though. So if you only have a couple $1,000s, maybe you just want to get it into the market, and that's one thing. But if you have some significant amount of money that you're investing in crypto, don't just pile it all in. It takes a lot of diligence to do this, but truly, you should DCA into the market. You should not just be lump summing into the cryptocurrency asset class because there's too much volatility and there's too much upside potential by waiting, just being a little bit more patient. So, you know, personally, I'm doing something like less than, so I have a pool of money on the side. And basically, after May, after everything ran up, I close to got out of the market. Everything that was in, long term holdings basically was sold. So basically, I was starting over then in May and then just slowly acquiring. And the way I'm doing it is, and again, you have to assess the value rate for you. But personally, I'm doing less than 1%, about, right around 1% of that money on the sideline designated for crypto per DCA period. So, you could think of that as being 4% approximately per month of that money. And that's not easy to do for everyone, but it gives you a more, a tempered approach to getting into the market. And like I say, you have to assess your own position. All right. I'm just telling you personally how I'm doing it. Now, the reason for that is because if the market starts going down, you know, you don't want to be all in right here in February of 2018 because unless you're ready to panic sell, you could be down as much as, especially in the altcoins, down 90%. And, if you're in Bitcoin, you could even be down 60%. So getting in slowly. Now, on the flip side, if you're just getting in slowly like this and using, like a strategy like we showed here, then you're acquiring a ton of Bitcoin. You still have funds to go when you're down here, and you're acquiring $3,000 Bitcoin, which is now worth, even in a depressed state, at $50,000. Okay. So for every $3,000 you put in, now it's worth 50,000. And that's on the low end compared to what you could, if you're acquiring a small amount of altcoins during this time, it could potentially be on the low end. So, if you don't have a lot to get into the market and, you're young and you're not nearing retirement or something, sure, you can, potentially, if you want to, again, I would still advise, getting into DeFi, etc. But if you're young, you don't have a lot of money, you could go all in and go into riskier projects. That's up to you. But, if you're investing serious money in crypto, you don't want to just be piling in, right? And like I said, even if you're not, even if you have still a relatively smaller amount, it still makes more sense likely to be DCAing in. And in this case, if you have just a few $1,000s, maybe you want to just be going into altcoins because, Bitcoin's not going to necessarily get you the type of gains you're looking for. That's an understandable approach. But even then, I would still be trying to acquire at least some position in your bigger altcoins like Ethereum, for instance. What I'm saying is this money on the sideline though, you want to have in DeFi. You want to be earning interest on it in the meantime. So just having it sit there on the sidelines and you're doing nothing with it is, you're just giving up a massive percentage of potential gains. For instance, if you're in a DeFi project, earning 20%, let's say, and you're acquiring over this time, well, this period where the market was depressed, this lasted from the beginning of 2018 all the way through, halfway through 2020 basically. So you could have earned 20% plus another compounded 20%, etc. And then just been investing that money into the market as the cycle goes on. All right. And the last thing that I just want to say, no one ever went broke taking profits. Okay. This is clear. I think everyone knows this, but it's the hardest thing to do. Don't just sit there. Don't just sit there and hope that something keeps going up. If you are up 10x, 20x, 50x, even 2x, 3x, take a little bit of profits. Like I showed you here, that's why a strategy using something like the DCA index is so valuable, because you're not guessing where a top may be. So with like Ethereum, for instance, you're not guessing when you may be approaching the top. You are quantifying it, right? So using something like a model, even if you don't use a model, even if you don't want to use the DCA index model, taking profits slowly, and you typically don't want to take them all at once unless it's just gone up wildly in a short amount of time. But taking profits slowly, even if you don't have a ton of money invested, will benefit you in the long run. Like it says, no one ever went broke taking profits. So that's my approach for 2022, guys. I know it's a long video. I know nearly zero people are going to make it to this point. That's fine with me. Nearly zero people are going to become wildly profitable in cryptocurrency. So it's probably about the same percent that make it this far. So with that said, guys, that's it for this one. And until next time, when I make the DCA index rundown video tomorrow, see you.